Welcome to the deep dive. So picture this, a huge company takeover, maybe a merger that completely changes an industry. On the surface, it looks simple enough, right? Company A buys Company B. But behind those big headlines, it gets really complex, financially speaking. How do accountants even begin to make sense of these massive multi-billion-dollar deals? Today, we're going to try and cut through some of that complexity. We're looking at how companies become, part of bigger corporate families, and crucially, how the numbers actually show that. There's just so much more to it than, just handing over a big check.
Absolutely. And what's really fascinating, I think, is how the global accounting standards, specifically, we're talking IFRS 3 and IFRS 10 here, they give you a very specific framework. A framework for valuing everything involved in the deal. And that includes stuff that isn't immediately obvious, like payments that might happen down the road, or even intangible assets, things you can't easily touch. So our mission today, for you listening, is really to get past the jargon. We want to uncover the basic ideas, the core principles dictating how these really significant deals get recorded. We'll touch on everything from the moment the deal's done through, say, changes in ownership later on, right up to how these companies report as if they're one single economic entity. The aim is for you to walk away with a much, much clearer idea of the financial architecture behind big business moves.
Okay, so let's start right at the beginning then. When one business buys another, what exactly gets included in that purchase consideration? It's definitely not just the cash paid on day one, is it?
No, not at all. It's much broader. The purchase consideration, it includes the fair value, sort of the current market worth of all the interests the acquiring company might have already held in the business it's buying.
So if they owned a piece already.
Exactly. Whether it was like a small stake, maybe an associate investment or a joint venture or just some other equity holding, the standard basically sees it as you giving up that old stake to get control of the whole thing. And that existing stake, it has to be remeasured to its fair value right on the acquisition date. Any change in value from what it was carried at before, maybe gains that were just sitting in equity that gets recognized straight away in the profit or loss statement.
That's interesting. So it's not just about the new money paid, but also revaluing what you already had in the game. Okay. What about payments that aren't even certain, like performance targets for the company being bought?
Yeah, good question. That takes us to what's called contingent consideration. These are payments that, they depend on future events happening, hitting certain profit targets maybe, or ROCE goals like you mentioned. And what might surprise you here is that this contingent amount, it also gets recognized at its fair value on day one, even if it doesn't seem probable that the payment will actually happen.
Really? Even if it's a long shot?
Even if it seems like a long shot at the time. Let's take a quick example. Say Company Josie buys 100% of Company Burton. The deal involves, say, $5 million cash immediately, plus maybe 2 future payments of $1 million each if Burton's return on capital employed, that's ROCE, goes above 10% in the next couple of years. Now, even with that uncertainty, you have to estimate the fair value of those future $1 million payments today. You discount them back using an appropriate interest rate, say 7%. So $1 million in 1 year discounted back, plus $1 million in 2 years discounted back. Let's say that comes to roughly $1.81 million in today's terms. That $1.81 million gets added to the initial $5 million cash. So the total purchase consideration recorded is $6.81 million.
Okay, so you're booking a cost for something that might never actually be paid.
You are. The key idea is to capture the potential total cost right from the start. It forces a more complete picture of the deal's economics, even with the uncertainty.
Right. Does that create headaches for companies, making deals look pricier up front?
It certainly can. It forces more upfront recognition. But it's about transparency, you see. It's also important to know what kind of contingent consideration it is. Is it treated like debt or like equity? If it's considered a liability debt contingent consideration, then if its fair value changes later on, those changes usually hit the operating profit or loss. But if it's classified as equity, like an ownership stake adjustment, then there's no remeasurement after day one. It just stays at its initial value.
Okay, that distinction matters then. Debt changes, equity doesn't.
Pretty much.
Yeah.
And there's another interesting angle here. What if you get a really, really good deal? Sometimes the fair value of the net assets you acquire, the assets minus liabilities, is actually more than what you paid. That's called a bargain purchase.
Like negative goodwill.
Exactly, negative goodwill. And any gain from that bargain purchase, it gets recognized immediately as income in your operating profit or loss. Oh, and one other quick point. The costs of doing the deal itself, legal fees, advisor fees, things like that, they're just expensed as you incur them. They don't get added to the cost of the acquisition itself.
Wow, okay. So accounting for money you might pay, even if it's unlikely, and the possibility of booking income if you snag a bargain. This really changes how you might think about the true financial shape of an acquisition, doesn't it? It's definitely not just the sticker price. All right, we've done with the purchase price complexities. Let's tackle two terms you often hear: goodwill and non-controlling interests. NCI. What exactly are these in this whole M&A context?
Okay, so goodwill. Under IFRS 3, it's defined pretty specifically. It's basically an asset. It represents future economic benefits that come from other assets you acquired in the deal, but assets that you can't individually identify and recognize separately.
So it's the intangible stuff, the premium paid.
Kind of. Think of it as the extra you pay for things like expected synergies, the companies working better together, or maybe the target's great brand reputation, a loyal customer base, maybe even a really strong management team. Valuable stuff, but not something you can easily put a separate value on and list on the balance sheet. NCI, non-controlling interest, that's simpler in concept. It's the portion of the equity in a subsidiary that the parent company doesn't own. Directly or indirectly. It belongs to the other shareholders, the minority owners.
Got it. Goodwill is the unidentifiable extra value. NCI is the piece owned by others. How do they connect in the accounting?
They're directly linked in the goodwill calculation itself. Goodwill is measured as the consideration you paid plus the value of any NCI minus the fair value of the identifiable net assets you acquired on that date. So you can see how you measure the NCI. That directly impacts the amount of goodwill you end up recording.
Okay, so the NCI value is a key input. How do you measure it? Is there just one way?
No, actually, IFRS 3 gives companies a choice, and they can choose on a deal-by-deal basis. There are two main methods. One is the partial method. Here, the NCI is measured just at its proportional share of the fair value of the subsidiary's identifiable net assets. The other is the full method. With this one, the NCI is measured at its full fair value. This often involves estimating the market value of those minority shares.
Partial versus full. Can you walk us through how that plays out, maybe with an example?
Sure. Let's imagine a company missile buys 70% of a subsidiary. Let's say the fair value of the subsidiary's identifiable net assets minus liabilities, $2,170 million. Missile pays $2,145 million for its 70% stake. And let's assume the fair value of the remaining 30% of the NCI stake is estimated to be $683 million.
Okay, got the numbers.
Right, so under the partial goodwill method, you take the consideration Missile paid, $2,145 million. You add the NCI's proportional share of the net assets. That's 30% of $2,170 million, which is $651 million. So 2,145 meters plus 651 meters gives you 2,796 meters. That gives you goodwill of $626 million. That's goodwill attributable only to the parent's share.
Okay, that's the partial method. What about the full method?
Under the full goodwill method, again, start with Missile's consideration of $2,145 million, but this time you add the full fair value of the NCI, which we said was $683 million. So 2,145 meters plus 683 meters equals 2,820 data assets, and that gives you goodwill of $658 million.
Right, so $658 million versus $626 million, a difference of $32 million.
Exactly. And that $32 million difference, that's the goodwill that's attributable to the non-controlling interest share under the full method.
Yeah.
So the big picture implication, this choice only really matters when you buy less than 100%, obviously. Choosing the full goodwill method means you report higher total assets on your consolidated balance sheet initially because you're recognizing all the goodwill, including the NCI share.
Does that have knock-on effects?
It can. It means any potential future goodwill impairment writing down the value, if it declines, might be larger under the full method. But on the flip side, testing for impairment might actually be a bit simpler under the full method. You don't need to do extra calculations to gross up the goodwill figure for subsidiaries you only partly own when you do the test.
Interesting trade-offs there. Higher assets, potentially higher future write-downs, but maybe easier testing. Okay, we've sorted the purchase price, we've figured out goodwill and NCI. What about all the other specific assets and liabilities of the company being acquired? Do they just get carried over at their old book values onto the new parent's consolidated statements?
No, definitely not. IFRS 3 is pretty clear on this. Essentially, all the identifiable assets and liabilities of the company you bought, as they exist at the acquisition date, have to be brought onto the consolidated balance sheet. And crucially, they're generally measured at their fair value at that date.
So everything gets revalued.
Pretty much everything identifiable. There are a couple of specific exceptions, things like deferred tax assets or liabilities, and maybe employee benefit obligations like pensions. Those tend to follow their own specific accounting standards rather than just a straight fair value rule under IFRS 3, but the general principle is fair value.
What about uncertain items like potential lawsuits or, conversely, potential future gains?
Good point. Contingent items. It's a bit asymmetric here. Contingent assets. So potential future economic benefits that depend on some uncertain future event are generally not recognized at the acquisition date. You wait until they become more certain. However, contingent liabilities, potential obligations from past events, like maybe an ongoing lawsuit against the acquired company, those are measured at their fair value at the acquisition date, even if uncertain.
So you recognize potential liabilities but not potential assets. That seems cautious.
It is, and after the acquisition, those contingent liabilities are remeasured over time. They're kept on the books at the higher of the original amount recognized at acquisition, or the amount you determine under the relevant standard for provisions, like IAS 37.
Okay. What about plans the acquiring company might have? Like, if they plan to restructure the business they just bought, can they book a liability for those expected costs right away?
That's a really critical point people often ask about. The standard, IFRS 3, is actually very restrictive here, and acquirer's ability to recognize a liability for, say, restructuring the acquiree's operations or terminating employees, it's severely limited at the acquisition date. Generally, the conditions needed to recognize such a provision under accounting rules, like having a detailed formal plan announced before the acquisition date, are very unlikely to exist right at the moment the deal closes. These costs are usually recognized later as they're incurred after the combination.
Right. So you can't just bake in your future restructuring plans into the acquisition accounting itself.
Not usually, no. And one more really important timing point. The acquirer has a window to finalize all this acquisition accounting. It's called the measurement period, and it's a maximum of 12 months from the acquisition date. You might inevitably record provisional amounts if you don't have all the final valuations, but you only have that 1 year to make adjustments retrospectively against goodwill or maybe that bargain purchase gain. After that year, the initial accounting is locked in.
Only 1 year. That seems like a tight deadline for potentially very complex valuations. It really emphasizes needing to get the initial numbers as right as possible, quickly. It's not something you could just keep tweaking indefinitely.
Exactly. It puts pressure on getting the valuations done thoroughly and promptly.
All right, let's zoom out now. We've looked at the pieces of the puzzle consideration: goodwill, NCI, assets, liabilities. How does this all come together in the consolidated financial statements? This is where the parent and subsidiaries start looking like one single company on paper, right? How does IFRS 10 make that happen?
Precisely. IFRS 10 is the standard that sets out the principles for preparing and presenting these consolidated statements. The absolute core idea behind it is what's called the economic entity approach. Basically, it treats the parent company and all its subsidiaries as if they are one single economic unit, one business. And what's quite interesting conceptually is how this approach views the shareholders. It sees all providers of equity capital, whether they own shares in the parent company itself or they hold that non-controlling interest in a subsidiary. It views them all as shareholders of this combined single entity.
Okay, so it's looking at the whole group as one thing, and everyone who owns a piece anywhere in that group is considered an owner of that whole thing.
That's the perspective, yes. And this perspective fundamentally shapes how you account for changes in ownership stakes after the initial acquisition, especially depending on whether the parent keeps or loses control.
Right, so how does that play out? What if the parent sells off, say, a small chunk of its shares in a subsidiary, but still keeps control?
Okay, that's a common scenario. If a parent disposes of a partial interest in a subsidiary, sells some shares, but still retains control over that subsidiary, then IFRS 10 says this does not result in recognizing a gain or loss in the main profit or loss statement.
No gain or loss, even if they sold the shares for more than they were carried at.
Correct. Because control is maintained, the transaction is viewed as happening within the single economic entity. It's treated essentially as an equity transaction, like the group adjusting its capital structure. Think of it almost like a company buying back its own shares, a treasury stock transaction, but happening at the subsidiary level. Any difference between the cash received and the carrying amount of the NCI disposed of is just adjusted directly within equity. There's absolutely no impact on goodwill either.
Okay, so selling shares without losing control is just an equity shuffle, no P&L impact. Let's make that concrete.
Sure. Remember Rage acquiring 70% of PIN with goodwill calculated. Let's say Rage initially acquired that 70% for $360. NCI was valued at $210 using the full method. Net assets for $480, so full goodwill was 90 meters. Now, later on, Rage decides to buy another 10% of PIN from the NCI holders. Let's say they pay $85 million for that extra 10%. Because Rage already controls PIN, this further acquisition is treated purely as an equity transaction, a transaction between owners within the group. There's no adjustment to goodwill. We need to figure out the carrying amount of the NCI that was bought out. If the NCI was 30% initially and its share of net assets, 480 meters, 30% plus its share of goodwill, 90 meters, 30%, 27 meters total, say 171 meters for the 30%, then 10% would be roughly 57 meters. Rage paid 85 meters. The difference between the cash paid 85 meters and the carrying amount of the NCI acquired, say $75 meters, including subsequent profit shares for simplicity here. That difference, maybe $9.5 million premium paid, is charged directly against equity, usually retained earnings.
Right, so buying more when you already have control is also just an equity adjustment. It shows how central that control concept is.
It really is.
Okay, so what happens if the transaction goes the other way? What if the parent sells shares and actually loses control? Say, they go from owning 80% down to 40%.
Now that changes everything. Losing control is a significant economic event under IFRS 10. If the parent loses control, even if it retains some interest, like keeping a 40% stake, which might now be classified as an associate investment where you have significant influence but not control, it triggers the recognition of a gain or loss on the entire investment that was held just before control was lost.
On the entire thing, not just the part sold.
On the entire former interest. You basically calculate a gain or loss composed of a few parts. First, there's the gain or loss on the portion you actually disposed of. Second, you effectively remeasure the interest you're retaining, the 40% associate stake in your example, to its fair value at the date control is lost. The difference between this fair value and its previous carrying amount is also part of the overall gain or loss recognized. Both components are typically recognized in the profit or loss statement.
Okay, that's much more involved. Can we see that with an example, maybe a step acquisition where control is gained first?
Sure, let's look at gaining control first, as it involves a similar revaluation principle. Say Company A buys 50% of Company B for $60 million. But crucially, A already owned 20% of B, which it had bought earlier for $20 million. Let's say just before this new 50% purchase, that original 20% stake was actually worth $24 million, its fair value. When A acquires the additional 50% and gains control, it has to remeasure that original 20% stake to its current fair value, $24 million. That $4 million increase in value, 24-meter fair value minus $20 original cost, simplifying slightly here, is recognized as a gain in the profit or loss statement at the point control is achieved. Then you'd calculate goodwill based on the consideration for the 50%, take $60. The fair value of the previous 20% stake, 24 meters, plus any NCI, the remaining 30%, minus the fair value of B's identifiable net assets. Maybe goodwill comes out at $14 in total. The key point is revaluing the old stake when control changes.
Right, and losing control triggers a similar revaluation of any retained stake.
Exactly. Now let's flip the Rage PIN example slightly. Suppose Rage, having control, later sells 10% of its holding in PIN to the NCI for $65 million, but still retains control. Say it goes from 80% to 70%. We said this is an equity transaction. Let's say PIN's net assets have grown and the carrying amount of the whole subsidiary, net assets plus goodwill, is now, say, $625 million. Rage is effectively selling 10% of that carrying amount, which is $62.5 million. They receive $65 million. That $2.5 million difference, 65 meters received, 62.5 meters carrying amount sold, is a credit directly to equity, not profit or loss, because control is maintained.
Okay, keeping control versus losing control makes all the difference in where that gain or loss shows up.
It's a fundamental dividing line. Now, the most complex scenario is probably losing control entirely while keeping a non-controlling investment, like an associate.
Right, walk us through the mechanics of that. It sounds like a lot of moving parts.
It is. When a parent loses control, IFRS 10 mandates quite a few steps. First, you have to de-recognize, basically remove from your consolidated books, the carrying amounts of all the assets, including any goodwill, and liabilities of the subsidiary you no longer control. You also de-recognize the carrying amount of any non-controlling interest related to that subsidiary. Then you recognize a few things: the fair value of any cash or other assets you received for the shares you sold. You recognize any shares you might have distributed to your own shareholders as part of the deal. And crucially, you recognize the fair value of any investment you're retaining in the former subsidiary, like that associate stake.
Okay, so old stuff out, new stuff. Consideration received and retained investment in. What else?
There's one more potentially significant piece. Remember other comprehensive income, or OCI. Those gains or losses that bypass the P&L initially, like maybe foreign currency translation adjustments on an overseas subsidiary. Any amounts related to the subsidiary that were previously recognized in OCI and accumulated in equity. They generally get reclassified or recycled from equity into the profit or loss statement at the point you lose control. It's as if the parent had directly sold the underlying assets and liabilities that gave rise to those OCI amounts.
So OCI balances get flushed through the P&L too.
Typically, yes. So let's try a final example. Rage initially owned 90% of Machine. Later, it sells off 65%, leaving it with a 25% stake, which is now considered an associate investment. Significant influence, not control. To calculate the gain or loss on disposal recognized in P&L, Rage would compare A, the fair value of the cash assets received for the 65% stake, plus the fair value of the 25% associate investment it's retaining, with B, the carrying amount of Machine's net assets, including goodwill, that were on Rage's consolidated books just before the sale, plus the carrying amount of the NCI that's being derecognized. Let's say doing that calculation results in a gain of $4.9 million. That goes to the P&L. On top of that, let's say there was $3 million accumulated in OCI related to Machine, maybe currency differences. That $3 million would also be reclassified from equity to the P&L, increasing the total impact on reported profit. And going forward, the remaining 25% holding would sit on Rage's books as an investment in associate, initially valued at its fair value on the date control was lost, say $25 million.
That really drives home just how different the accounting is depending on whether you keep control or lose it. It raises a big question, doesn't it? Why is the treatment so drastically different? It really hammers home how fundamental that concept of control is for financial reporting. It's clearly the absolute linchpin for almost everything we've discussed today. So, after all that detail, what's the main takeaway for you listening? Well, hopefully you've got a much better sense now of the real mechanics behind how major business combinations get reported. We've seen it's way more than just the headline purchase price. It pulls in the value of previous stakes, estimates of future payments, the sometimes fuzzy idea of goodwill.
And I think if you connect this to the bigger picture, getting your head around these IFRS 3 and IFRS 10 principles gives you a real edge. You can now look at a company's financial statements after a big acquisition and better understand the full story from the initial deal structure right through to how subsequent changes in ownership are reflected. And you can appreciate how certain choices management makes, like how to measure NCI, can actually impact the numbers reported, both now and in the future.
Definitely. So here's something to mull over, a final thought for you, the curious learner. How might these really quite intricate accounting rules, especially the way goodwill is handled, or the choices available for NCI measurement, or the stark difference between keeping and losing control, how might these rules actually influence the strategic decisions companies make about mergers and acquisitions in the first place? Could it be that these accounting details, going beyond just the immediate dollars and cents, actually shape how companies choose to expand or even whether they choose to expand through acquisition? Food for thought.